Taking a look at all the drama that has been playing out over the past week or so on the interest rate front, concerns coming through from North Africa and the Middle East as well, and looking at the GDP numbers that we've also seen for the fourth quarter of last year, we've seen two negative numbers from Japan and the UK. That said, we have in fact seen a V-shaped recovery on a global level.
That's correct. If we look at the global growth rate of last year, it's estimated to be in the region of about 4.5%, and we think there's very good reason to expect that growth to be sustained into 2011. We've now reached the stage where we don't think there's much governments can do anymore to stimulate growth. So to sustain that growth going forward, there are two very important things that we follow. The first is whether companies are profitable, and therefore whether companies will start investing, whether they've got the means to invest, and whether they will therefore also start hiring more people. If we look at company profitability, that is increased in all the developed markets and the emerging markets as well. So we think that companies have got lots of spare cash. They should start using that. So the next phase of the economic growth we're likely to see, corporates are in a good position to drive that. In addition as well, obviously you need households to spend. In many parts of the world, households were saving more over the last few years, but they've upped their savings rates now, and they're now in a good position to benefit from the lower interest rates that we've seen internationally over the last 3 years as well. So, for example, in the US, if you look at how the interest service burden of households have come down, it's given them substantial extra room to spend, and this is the case in most other countries as well. So those two key drivers, we think, are probably enough to sustain growth going into 2011 in the developed world and the world as a whole.
Well, I mean, let's touch on corporate profits. You alluded to it, and we have seen a significant increase from what we saw this time last year. Emerging markets, though, outperforming on the corporate front. The developed markets also doing relatively well. You're talking about a stronger balance sheet for the consumer and also for corporates out there. We're starting to see cash coming through, but the question is how much of that is going to be spent. It seems that there's still a lot of risk going forward, and some companies are very worried about perhaps embarking on capex spend. Do you think that scenario could change, and where do you see the most activity happening?
I think it's quite true to say that if you look at the situation currently, a lot of corporates will still be hesitant. We should not forget, I mean, we didn't call it the Great Recession for nothing. It has been the worst downturn in many decades in most countries. So having experienced those tough times, there might be a bit of a longer lag before corporates start spending. But the one thing that has survived pretty well during this recession, and certainly into the upswing, is the improvement in profitability. And we think that will give corporates the confidence to carry out those spending plans and eventually hire more people as well.
You're also talking about a much healthier balance sheet for the consumer out there, and one of the reasons that we could see a drive up in profits is if we see the underlying consumer demand. That hasn't really fed through in the US economy. When you look at the January retail sales number that came through up 0.3% below expectations, one wonders the health of the US consumer in particular, because it is a very big driving force on the global recovery scale.
Oh, absolutely. I mean, the US consumer is still the single most important consumer, in terms of the world economy. The January number, yes, is disappointing, but and we see it as 1 month within a trend, and the trend is certainly, as you mentioned, a much better balance sheet, certainly on the liability side for consumers in the US. Plus, consumers are now saving between 5 and 6% of their income. So we believe that they've got more than enough going for them to spend more into the year that we're in. And in addition, in the private sector, certainly, we are seeing job creation slowly but surely starting to pick up in the US, and that will give a further boost to spending in the US this year.
Well, it's interesting. Also, debt to disposable income, as you've alluded to, in the US has also come down, which is a very good boost for the US. But again, you mentioned unemployment. That is still one of the big hindrances. And when you look at the Fed, and they still very much in the view of keeping that stimulus package intact, does that not create some concern that if without the stimulus packages, that the US economy could perhaps fall apart?
No, we think that if you look at it, as I said, the corporate profitability and the improved balance sheet of consumers should sustain economic growth. I think the Fed is probably playing it too safe under these circumstances. And our reading of the US economy is that gradually over time, it should be able to stomach even interest rate increases. But in the scenario that we're looking at, with the Fed playing very safe, obviously there's still the risk of higher inflation down the road for the US economy.
Okay, let's touch on the South African consumer at this point in time. 8.3% growth coming through on the retail sales front for the month of December. We've got a low interest rate environment. We still have high debt to disposable income. Tell us what your concepts are when it comes to the South African scenario from a consumer front, because some say that number could taper off. We could see retail sales come down to around 5% year on year.
Yes, if we look at obviously the 8% retail sales growth, I mean, that is close to a huge boom in retail sales. Coming off a low base, obviously one's got to judge that number as well. But in South Africa's case as well, we've had consumers experiencing quite nice real wage increases, with at the moment still low inflation. And if we look at it further into the year, interest rates are at 30-year lows in South Africa. Consumers are benefiting from that. And certainly with the world economy improving, our open economy will benefit from that. The higher commodity prices will also feed through into better spending, we believe, this year. So we're not pessimistic in terms of these kinds of growth rates, maybe not at 8% for retail sales, but slightly lower, for that to be sustained in 2011. Well,
that said, let's take a look at the overall equity market in South Africa. We did breach new all-time highs, intraday highs. Of course, we didn't close on that 32,233 points that we saw in May 2008. But it is interesting to note that some are saying that the markets are looking overpriced, that we should see a correction. Do you think that the South African market right now is looking a bit expensive?
We tend to look at equity markets not in the short run, and if we look at the longer term fundamentals and the longer term potential profits for companies, we believe the market's not overpriced where it is currently, and one can still generate reasonable real returns from South African equities going forward. But one must caution is these won't be the real returns that investors have experienced over the last 5 and 10 years in the local market.
Would you be selling at this point in time? What would your asset allocation be, given the fact that we've also seen a big drop in South African foreign flows? We're starting to see a slight recovery now, but since the beginning of the year, we have seen foreigners selling South African assets.
Yeah, if we look at foreigners selling South African assets, emerging markets have in fact been lagging developed markets over the last little while. Some time ago, people were very pessimistic about developed markets, thinking there's never going to be any growth in Europe or the US, for example. They've been surprised on the upside. And a lot of money that's moved into the emerging markets are now returning to the developed markets. And I think one's got to view the flows in and out of South Africa in the same context. However, if we look at the range of asset classes available to investors out there, we find that equities still present us with the best investment opportunities. If you look at it for a local investor, probably overweight somewhat the offshore investments or offshore equities relative to local equities. The one asset class that we still are hesitant to put onto the buying list is certainly international government bonds. Although interest rates have risen substantially, we think that's still below their fundamental value, and with short-term interest rates so low, that still poses a risk for long-term interest rates as well. However, when we look at it locally with long-term interest rates in the region of 8.5%, if you had the luxury of not being fully invested in long bonds right at the bottom of the short-term interest rate cycle, we believe you can selectively start buying some of those long-term government bonds now.